Good morning, everyone. My name is Mike Lausch. I'm the chairman of Cardno, and I'm here with four other people. I'm here with Matt Courtney and Shale Munks, and as well as Ian Ball and Peter Barker to talk about the Cardno demerger. What I'm going to do is just do a very quick introduction in regards to the proposed demerger, and then I'm going to hand over to the executive teams respectively of the two businesses that we're looking to demerge. My role here really is to do that introduction and to give a little bit of colour as to why we're looking to do this today, and then also to allow shareholders and investors the opportunity to ask questions not only of the others but also of myself, both as chairman as well as the largest shareholder in the company at the moment, in case people have any questions as regards to Crescent. So without further ado, I'm on page 2, and I won't really labour the point here. It's a very dense slide that you've all got in front of you. I think the real takeaway comment from this is that we've come to a conclusion that Cardno's consulting and quality testing and measurement businesses are now both of sufficient scale to operate separately, and we think that they, as a board, they would benefit materially from operating independently of each other. And I'm going to go into that into a little bit more detail. So if I turn to page 3, which is really the guts of what we're here to talk about today, why has the demerger been proposed in the first instance? Well, I think it's pretty simple, really. We think we have two very attractive businesses that we've got quite material growth prospects in front of each of them. And we think that they're best served in terms of achieving their goals and ambitions and aspirations to operate independently of each other. We also think that the best way to manage capital in such a structure is to be independent of each other, so that we don't have a capital rationing situation going on between the two businesses, nor does one business allow them to take into account the different risk profiles, growth profiles, different markets that they each operate in. It's quite an interesting experience if we turn the clock back a little bit and think about Cardno over the last few years. Following the takeover that took place in Cardno 4.5 years ago now, one of the things that we noticed was there was a difference of businesses within the Cardno business that operated as one company. And really some of those businesses were struggling to operate within the environment that they were in, or the operating environment that they were put in within Cardno. And what that saw us do as a board was that we separated a number of those businesses out into what we called portfolio companies. And the main reason for that was to give those companies a different operating structure from which to operate, and to give them more flexibility to be able to get on with what they wanted to do outside of the core business and the largest business, which was the engineering consulting services business. And that's worked quite well. However, it still had its challenges within the one business in terms of when we think about capital allocation, how we think about growth opportunities, how we think about cultural alignment, how we think about decision making and what goes on in those businesses. But one thing that happened last year was with the acquisition of the Rava-Kistner business, we came to a conclusion that we finally had the measurement testing part of the business of a critical scale and mass that it could operate independently as its own business. And why that was attractive to us was that we found and we felt that both businesses have quite material opportunities in front of them, whether it's through acquisitions, whether it's organic growth opportunities in different markets, whether it's the way in which they deal with their various customers. And we felt that the best way in which to execute a strategy or a successful strategy on each of those businesses was to look to separate them, give them an independent management teams of each other, give them an independent capital structure of each other, and let them really be accountable just to themselves rather than to a broader group. And that really was the reason why we proposed this demerger. At the end of the day, we just think that this is going to generate more value for shareholders than operating within the one environment. I think there's a secondary issue as well, is the two businesses operate in different markets and they actually trade at different multiples. So when you look at a peer comp set for a testing business, it's quite different to the engineering services business. And so again, we felt that the best way to maximise value for shareholders, not only on a future growth and aspirational basis, was also for the two businesses to be able to be recognised differently from a valuation perspective. So what are the advantages of the demerger? Well, we think there are quite material advantages. Each business will be more aligned culturally and operationally and be much more homogenous in the way in which it goes about its business and what its business represents. Investors will have investors with different investment strategies and preferences can choose their level of investment in Cardno and Intega. And on day one, they get a similar amount of equity in each business, but they can change and that can evolve and change as the needs of each of those businesses changes. With a separate board and management team, the businesses will be much more empowered to pursue those independent strategies and operational initiatives and capital management opportunities. And really, we can really tailor the capital structures and financial policies of each business based on what the needs of each business are, because they're quite different. The disadvantages of the merger. Potential disadvantages are that each entity will be smaller and less diversified. I suppose we would argue against that because we think each business will be more dynamic, and we actually think that they will grow faster independently of each other than they would together. You could also argue that the businesses will have additional corporate, financial and operating costs. Again, I think one of the opportunities here is that each of the businesses requires a different level of corporate, financial and operating costs. And when they're as one business, we're probably not getting the best outcome for each business operating within that one straitjacket. There is definitely a cost associated with the transaction costs with the demerger. However, when we sort of sit back and think about the broader or the greater good or the broader benefit that we think we will generate, then we think that that is an immaterial cost in the process. And finally, just on page 3, the last thing I would like to say is each Cardno director intends to vote or cause to be voted all their Cardno shares held or controlled by them in favour of the demerger resolutions. And inclusive of Crescent, that represents 50.4% of the register. Now, I'm not going to talk to page 4 because I'm going to leave that to Ian and Matt to talk about in respect to their respective businesses when we get to that section of the presentation. What I will turn to is page 5, and really the Cardno, Intega and Cardno investment highlights. One thing that we're trying to show here on this page is when you look at each of the businesses and think about the topics on the left-hand side in terms of growing markets and backlog, market positions, ability to deliver landmark projects, investments in growth, competitive advantages, significant growth opportunities in management, each business has material opportunities in front of it, which we're really quite excited about. And again, I don't want to labour the point by going through this in detail, but I suppose just pulling out a couple of points. You know, we think the opportunity that each business has in the US market in particular, from both an organic growth perspective as well as an acquisition perspective, is material. And one of the things that we would prefer each businesses to do is to really assess those opportunities in terms of how they invest their capital, whether it's into acquisitions or organic growth initiatives or into new markets, independently of each other, and not have to think about a capital rationing or a capital allocation based on the needs of one part of the business or the other. We think that if each of them was operating independently, they will be a much more homogenous business, and the materials testing and QA business that'll be all it will be, albeit in multiple geographies, but that is all it will be. And similarly, the Cardno business that remains will be a very clean engineering consulting services business, and that is again all it will be. And so its ability to engage in those markets and think about how it's going to allocate capital, how it's going to grow, is a much more pure way of thinking about strategy and how it can execute on what it wants to do than it is within a broader business. I think the other thing to just also highlight is that each of the businesses has material opportunities in front of it in regards to the markets and the growth that those markets are undergoing at the moment, particularly again in the US, as well as in Australia, but I suppose we're focusing on the US given the size of those markets. And we're very excited about how representing a single-minded business is going to assist that sort of execution strategy. So I might turn now to page 6 and just talk a little about how the separation is going to work. We're not introducing any new management across the business to execute on this strategy. Matt Courtney has been running the QA side of the business and the materials testing business for many, many years. And he will continue to run that business. He will be just running it independently of Cardno. And similarly, Ian Ball, the current Chief Executive of Cardno, will stay on with the business and run the balance of the business and the rump of the business as he has been for the last year. What will change, though, is the structure of the boards. The board will sort of shrink a little bit on the Cardno side. So right now there are 3 representatives from Crescent on that board, being myself, Neville Book as Deputy Chairman, and Nat Thompson, and we have 3 independent directors. The Cardno Consulting Board will now turn to having 3 independent directors and 2 Crescent directors. Neville Book will leave the Cardno board. Neville, however, will join the Intega board as the chairman, and I will also join that board as a director. And then we'll have 2 independents, being Jeff Forbes and Steve Sherman, joining as well. So what we're intending to do is we don't want to lose any momentum. We want to have a consistent approach in terms of the way in which we've been working across the businesses today. But what we want to do is sort of separate out the 2 boards so that they can operate independently but have the same approach culturally as well as from a strategic perspective as they have to date. The other benefit of doing the split this way is, at a board level, is that during the transition period and separation period, which will be running for about a 12 to 18 month period as we slowly move out of the transaction services agreement that Intega has with Cardno, the fact that we have some shared board members means that we will be able to make that process as seamless as possible and have a consistent approach based on what our intention was and the philosophy with which we've adopted the TSA agreement at the point of demerger. So we're hoping to decouple in as efficient and smooth way as we possibly can. So I think without any further ado, I might move over and let Matt introduce himself and give an overview of the Intega business.
Thanks, Michael. We're on slide 8. So I'm Matt Courtney, CEO of Intega. I will say that I'm very excited about the opportunity that Intega represents for myself and for our management team. And I believe it's the right decision for both Cardno and Intega. My history, I've been involved in the business that formed Intega. The core business of construction sciences was biology geotechnical. I've been involved in that for 30 years. I've worked at all levels of that business, and that's true of all of our senior management staff, that we've got a long history and we understand the business really well. And also I've been involved in the expansion of the business, both organically and with acquisition. And in fact, Shale and I, with our colleague Jared Midgley, led the due diligence on Raba-Kistner, which is the large US acquisition. I'll talk a bit more about that later. And I think over the 30 years, myself and all of our operational managers have got a very deep knowledge of the quality testing and measurement businesses that we run. So I agree with Michael's comment that this business will be a lot simpler to understand, I think, on its own. I'll move on to slide 9. So that there are 4 core businesses that make up Intega, and these are Construction Sciences, which is a construction materials testing business headquartered in Australia, which works in Australia and the Pacific. That business was founded in 1990 and was acquired by Cardno about 11 years ago. Raba-Kistner is a very similar business. It's a CMT business which is headquartered in Texas and works a lot in Texas, but it was founded 50 years ago. It also has spread into other US states, which I'll talk about in following slides. That was acquired in late 2018 by Cardno. And then we have PPI, which is an oil and gas focused business which carries out QA on oil and gas componentry and inventory. And it's a very niche business. And the 4th one is T2, which is a utility engineering business. It maps underground services and does engineering work for relocation of services. So all of the businesses have a long history, at least 15 years, some 30 and some 50 years. The strategy that we have for Intega was actually started about 3 years ago when those businesses were treated as portfolio companies. So we've had sort of a large amount of autonomy for 3 years. So we don't think that this demerger is terribly complex in terms of operation for us. And the final thing I'll just comment on this slide is that when we acquired Raba-Kistner in 2018, that really gave critical mass in terms of the size of the business to allow it to separate out. I'll move to slide 10. So as I said on the previous slide, there's 4 brands that we run, and I'll give some examples of what these brands do, just to give some colour. So Construction Sciences is the Australian construction materials testing business. And what this business does is, if you think of any construction project, we carry out quality assurance testing on any construction element. So that might be the compaction of earthworks or the strength of concrete used for pavement or any number of other construction elements that we use. We actually provide conformance data to the constructors, and the constructors use that to tick off hold points against the specification. And essentially they get paid based on conformance with the specification. If we move to Raba Kistner, that's actually a very similar business in the US, headquartered in Texas. And it does construction materials testing, but it also has a service where it provides the conformance materials to the constructors. PPI, Quality Engineering, is the oil and gas business. It's, again, similar. It carries out inventory and quality control of oil and gas components. So it might be, for example, a wellhead that's required for an oil well. The PPI team will make sure that that wellhead's manufactured to the correct specification, and many other components also. TT Utility Engineers, and that's something that we have both in Australia and the US and Canada, maps out services. So if you took a project such as Sydney Light Rail, you would have an old development in a city where the constructor does not know what services are where, so our team will go in and find all the services and map them. And if they need to be moved, we come up with solutions to move them. Otherwise, we just map where they are so that they don't get damaged during construction. I'll move to slide 11. So what we've built in Australia is about a 900-person organisation with about 50 offices, permanent offices around Australia. We're the only provider of construction materials testing services that's genuinely national, so we can get to anywhere in Australia and parts of the Pacific. We work across every sector, so we're quite diverse in it. We don't particularly target sectors. We just enter sectors as we need to, and the beauty of that is that we have diversification. So when mining is hot, we're in mining. When oil and gas is hot, we're in oil and gas, and when government infrastructure is hot, we're in that sector. Noting that we have always stayed in infrastructure. Sorry, so I'll move on now to slide 12. So in the US, about 1/3 of our staff's in Texas, and the higher proportion of our profitability is in Texas. The key difference in the construction materials testing that we do in Australia to the US is that we actually provide inspection services and conformance as well. So it's an additional service that we provide, but similar business. And the key opportunity we have is to replicate what we do in Texas into other states. We've actually already done that successfully in Arizona and Utah, and just recently in California. But the opportunity we have is that our large clients as they move to different projects in different states, we are invited to move with them. Slide 13. This slide deals with software. So there's a commonality with certainly Construction Sciences, Raba Kistner and PPI, where all 3 of those businesses have developed software, which is proprietary to them. And they're all developed by our operation, with the input, of our operational staff. And the reason we've done this is that there's not commercially available software that fits our needs. So we've developed our own software, and we're competing with companies that are smaller and haven't invested in systemising their processes like we have. And so I'll just give some examples of why this software helps us. So the Construction Sciences software is called Comply, and it basically ensures that a staff member can't do any work unless they're qualified. So it measures their qualifications and training, make sure they're up to date. It makes sure the equipment we use is calibrated, and it audits results. So if any result is changed, any number is changed, it audits that and feeds that back. And what we find is that clients and owners, like for example RMS, appreciate this because they can come in and audit our system and know that what they're getting is quality data. Elvis is the rubber Kistner software. It's what it does is it actually takes test results and then manages the specification compliance of a project by matching the test results against the specification. And the thing to note there is that if we add comply to Elvis, we will have a much better package of software that can do a lot more things. So that's something we'll definitely look at. QA Reporter is the PPI software. It does a similar thing where it measures both inventory for oil and gas components and the compliance to specification of components. So that might be the example I gave earlier would be a wellhead or something similar to that. And basically all three of those software packages embed Intega into our clients' processes, which helps us. On to slide 14. About a third of the revenue is in Australia of Intega, and the other 2/3 is in the US. In Australia, I've spoken about it before, that we manage cyclicality by moving from sector to sector. But we've always stayed in infrastructure, and the information on this slide is showing that we believe that the Australian infrastructure pipeline will stay strong for at least the next 5 years, and I think longer. And in the US, it's a similar story, but there is underinvestment in infrastructure at the moment, particularly in Texas. There's actually a constitutional amendment which provides funding for particularly highways, and that again brings home to us that the infrastructure market in the US, but particularly in Texas, will stay strong for the next 5 to 10 years. And with that, I'll hand over to Shale.
Thanks, Matt. So slide 15 shows the Intega pro forma profit and loss for full year 17, 18 and 19. The 17 revenue for the group was 312 million with an EBITDA of 6.5. The 17 result actually included a loss of $6.2 million for PPI, our oil and gas business. During the year, the business closed its operations in Nigeria and Angola and restructured to move away from a labour hire contract business to focus on quality assurance work. This refocus has turned the business around, and in 18, PPI made a small loss. However, in 19, the business has returned to profit with a positive EBITDA swing over the 3-year period of nearly $9 million. In full year 18, the group had revenue of 332 million and an EBITDA of 20.5 million on a pro forma basis. The increase in the results for this year was primarily attributable to organic growth in Australia and America in our construction materials testing business, as well as the turnaround of PPI that I just mentioned. For full year 19, Intega had revenue of 417 million and EBITDA of 29.8 million, again showing strong growth in the construction materials testing business in both Australia and the US. The UES business in the Americas broke even in full year 19 due to loss-making areas in the US. This business is our focus for turnaround in full year 20, which Matt will talk to more in a couple of slides. For margins, the bulk of our business, being the construction materials testing business, runs at a 10% margin. The oil and gas and T2 business have been running below 5, and we're working on improving these. We expect that T2 in particular will increase significantly. The last thing I wanted to mention on this slide is the increase in depreciation and amortisation, which is mainly due to acquisitions, an increase in motor vehicle leases, and identifiable intangibles we acquired through the Raba acquisition. Turning to slide 16. 16 shows the Intega balance sheet as at the 30th of June 19. The group exited the financial year with approximately 50 million in net debt, 60 million in debt and 10 million in cash, which is roughly 1.7 times our EBITDA. Total available debt under our new facility is around 107 million. And our net debt to EBITDA covenant is 3 times, so we've got plenty of headroom and around $50 million in capacity for any future acquisitions. Property, plant and equipment is mainly lab equipment, motor vehicles, and some office furniture and equipment. The intangibles you can see there is primarily goodwill, as well as customer relationships and customer contracts identified on acquisition, and these are generally amortised over 3 to 7 years. The other thing I wanted to point out on this slide is that included in our trade payables and our other non-current liabilities is around 17 million in earn-out payments for our recent acquisitions. The acquisitions are performing to or exceeding our expectations, so we expect to pay these out over the next 3 years. The next slide, slide 17, shows Integer pro forma cash flow for the last 3 years. As you can see, the group has generated nearly 60 million in operating cash flow after CapEx, with EBIT conversion over 100% each year. The CapEx for the group primarily relates to the motor vehicle and equipment, which, due to our policy in the US of putting the vast majority of vehicles on operating lease, is quite modest. I'll hand it back to Matt now to go through our final slide.
Thanks, Charles. So I think what I'd like to point out is I think with Integer we've demonstrated our capacity to grow organically in Australia, and we expect to continue doing this through expanding our service footprint and market growth. There's a similar opportunity in the US, but significantly greater geographical growth opportunity in terms of growing into other states. And I think the truth is that we'll grow by both acquisition and organically in the US, and more organically in Australia. We need to improve the margin of the UES company, T2, which is a $90 million revenue company. And we've got an improvement plan in place that we've had in place for a couple of months now. So we expect to see improvement in that. Once we get that business stabilised, we'll look to grow it, but we want to stabilise it first. So yeah, with that, I'm very excited about the opportunity, and so is our team. And I'll hand this on now to Ian and Peter.
Thanks very much, Matt. Hi everyone, my name is Ian Ball. I'm on slide 20. I'm the CEO, Managing Director of Cardno, and I'll be looking after the consulting part of the business post-demerger, assuming that we move ahead as planned. I've been with the business a year now, and I have a long history, as you can see, in professional services and in running consulting businesses. And I think that I'm very much looking forward to taking forward the Cardno business and running a professional services business with a greater degree of focus. As Michael said, I see a lot of opportunities out there in front of us, and I think that we're really getting the business focused on 3 things as we move forward. One is client excellence, the second one is people excellence, and the third one is delivery excellence, and we see opportunities to make advancements as we move forward. Working with me in the new Cardno consulting entity is Peter Barker. Peter's been the CFO of Cardno since 2016. I've been working very closely with Peter for the last year or so, so it's really just more of the same in terms of the leadership. I have 3 divisional CEOs reporting into me, and I'll go into each one of the divisions in more detail in a second. Moving to slide 21. Next year, in 2020, we look forward to celebrating the 75th year of Cardno's establishment as a business. And you can see some significant events in our history on slide 21, including back in 2008, as Matt has already covered, where we entered the materials testing business. And that business was the genesis of what will be Integer moving forward. And you'll see some notes that in anticipation of the proposed demerger, we started making some movements in the Cardno business in 2019, which included earlier this year moving UES to the portfolio company fold in anticipation of the demerger announcement. So we've been working and thinking about the split for some time and working on the operational aspects of that. Moving to slide 22, what Cardno will represent going forward is an organisation with some $950 million, as was in FY19, of revenue, and that's split in three primary divisions. And as I said, I've got three CEOs reporting into me, and through those divisions, we offer great diversity. Get diversity not only geographically in all of our businesses across the Americas, Asia Pacific, and in the international development business that works in developing markets on the behalf of government sponsors, but diversity and also in our client set as well. So we've got a number of government clients in there, including large government agencies like DFAT in Australia and the the Commonwealth Office and Department for International Development in the UK, and then USAID in the US. Then obviously we work for state and local governments in Australia, and then private sector companies in Australia and the US. So for instance, in Australia we'll work for the likes of Stockland and Lend-Lease in urban development. In the US we work on the environmental side for many energy companies like Exxon and some of the big utility companies. So we're a very well diversified company from a geographic and client set perspective. We've got about 4,500 people, as we will in the consulting business, and we've got about 125 locations. Moving on to 23 to get a bit deeper into each one of our businesses. So in the APAC region, about just shy of 1,400 staff, 29 offices. I think what's really key and core to our business is in Queensland, in New South Wales, and now in Victoria as well. We not only have capital city locations, but we cover the regional areas of those states. So you might remember we made an acquisition in Victoria called TGM, and that complemented the location that we had in Melbourne to really cover Victoria as a whole and expose ourselves to infrastructure opportunities in Victoria. In New South Wales, we've got Sydney, and then we stretch all the way down the coast as far down as Wollongong. And then in Queensland, we have our Brisbane office, which is the head of our Queensland location, as well as our global head office. And then you can see dots up the coast of the Queensland coastline all the way up to as far as Cairns in the north. So diversification in terms of location, and then on the bottom of that slide you'll see the many different sectors that we cover. On looking at the staff mix, primarily we're an engineering business, but we also have staff who are expert in science in our environmental business. We've got a great deal of drafters and designers and various other functional experts, as well as planning capabilities and surveyors, covering all the markets in quite a diversified engineering, environmental and infrastructure business in APAC. Moving to 24 for the Americas business, slightly less in terms of numbers, about just over 1,200. More offices. We have slightly different structure in the US, where we run, rather than running by a regional type organization as we do in APAC, we run by line of business. So we will have three primary businesses underneath the Americas business: a government services business, an infrastructure, civil transport business, and thirdly, a science and environment business that leads a lot of the science and environmental work that we do in the Americas. Although we have a lot of locations, we really do have a great deal of focus in Florida, in Texas, and in California, where we find those markets and the kind of client spend very attractive to us. You can see the staff mix is somewhat different, given the leading position that we have in environmental services in the Americas. So actually 44% of our staff in the Americas are scientists, as opposed to 48% of our staff in APAC, which are engineers. But we also have obviously engineers in the Americas too. We cover a similar set of client sectors, and as I said already, we see big upsides for growth. Roughly speaking, the Americas market is about 20 times as large as the APAC market. So you can see that with roughly the same scale of business, we have lots of upside for growth in the Americas. Moving on to the slide 25 to talk about the International Development Division. This is our developmental consulting business. In essence, we work for 3 clients, and that's really summarising at a very high level, but we're working really for the UK government, the US government, and the Australian government, and we project manage their development projects in many, many developing markets. So we're talking about West Africa, we're talking about Asia, we're talking about the Pacific, where we're working for developing countries, and we will project manage types of projects that will go from hard infrastructure, so supervision of construction of roads and bridges, all the way across to putting healthcare systems in place, government procurement systems in place, legal systems in place, school building and educational projects. So a vast variety of different projects, a great deal of interest at the moment in international development for all kinds of different reasons, and we're very well positioned, particularly as you can see from the staff numbers in Asia Pacific, where we're the lead advisors to DFAT in managing their development projects across the region. So that's, I hope from those slides you've got a good sense of the coverage that we have, the diversity that we have, and I feel very strongly that we've got a tremendous amount of upside in the business, both in revenue growth, but also in margin expansion. I believe that this business should be a solid double-digit EBITDA margin business, and that indeed is a lot of the focus that we have at the moment in improving margins as well as growing top line organically and through acquisition. With that, I'll pass to Peter, who's, as I said, my CFO, and he'll take us through some of the numbers in recent history. Thank you.
Great. Thanks very much, Ian. So we're now on to slide 26, which is Cardno's pro forma P&L for FY 17, 18 and 19. Now, investors will recognise a lot of these numbers as these are segments that Cardno has had in place for the last 3 years, being the Americas, Asia Pacific and International Development. The only exception is the Americas, where, as Shale referred a little earlier, the survey business, which historically has been in our Americas business, moves across into Intega as part of Matt's team. So apart from the Americas, you are looking at the same numbers that you have seen through our results, our 4D and 4E for 17, 18 and 19. Now, if we look at each of the years, as you can see, we put in the headline, revenues are effectively flat, but as Ian said earlier, we've got 3 quite distinct businesses. Within Asia Pacific, they have had a tough year, and as we spoke at our results call, we have invested in or held costs associated with major projects, and we took some actions in June of 2019 to address that cost structure. And pleasingly, the Asia Pacific business is well set up for growth in the future, and Ian referred to the margins that we aspire to in that business, both in the business generally, but specifically in Asia Pacific in the future. The Americas, we invested in business development 2 years ago, and the Americas is really starting to see the return from that with healthy growth in revenue and also even more pleasingly, healthy growth in margin. And the way I think about it is that the Americas is effectively 12, maybe 18 months ahead of Asia Pacific. So we are investing, under Ian's leadership, we've been investing in business development in Asia Pacific, and all going well, we would hope that we will see the benefits of that in the halves to come. Our international development business, the margin is slightly down, FY19 on FY18. However, as we said when we released our results, they are ahead of internal targets, and we're really quite pleased with that. And again, we're investing in the international development business. And on a comparatively more modest margin, you do actually see a modest investment actually does change the bottom line result there. In the bottom left-hand corner of the page is our EBITDA, and then taking it down to EBIT. I'll let those numbers speak for themselves. If we move forward onto slide 27 at least, this is the balance sheet, the pro forma balance sheet. So what that represents is Cardno with the Integer balance sheet split out. And again, as at 30th June 2019. Now, like the Integer business, we exit FY19 with a very conservative balance sheet. That has been our company's philosophy for the last 4 years, and it will continue. Our debt facility, our net debt of some $47 million represents a gross of 83 with a facility of over $190 million. So like Integer, Cardno has considerable financial headroom and financial horsepower. Our covenant sits at 2.5 times, which is consistent with our Cardno's existing facility. So again, reflects fiscal discipline in our structure. Like Integer, Cardno has substantial tax assets, primarily in the United States and Australia, which is important when you look at the cash flow that we will generate. If I move forward on to page 28, which is the pro forma cash flows. Now, if I draw your attention to the fourth line from the bottom of the table, which is the operating cash flows after CapEx, but before financing costs and tax. And as you can see, Cardno generates, we had an unusual year in FY17 where, and investors will recognise this discussion because we've been talking about it for the last 3 years, whereby the timing of large client payments in FY16 and FY17 caused us to have a very, very strong cash flow in FY16 for the group, and equally the flip on FY17. We've been working on that for the last couple of years and have largely smoothed that out, such that you see a healthy net operating cash flow come through the business. Our CapEx is comparatively modest, reflecting what we do. So then I draw your attention then to our financing costs. Now, we bullet that out on the bottom right-hand corner. So if we take FY19, for instance, the company executed, this is the entire group, so we reflect the buybacks and indeed the debt repayments for the entire group for FY19, 18, 17 on this table. And in FY19, the company bought back just under $22 million or $21.5 million of Cardno stock. Lease liabilities were $3.4 million, and our interest costs were a little under $8 million. All of the delta is repayment of debt. And again, this reflects the fiscal discipline I've referred to and I've been speaking about over the last 4 years, that surplus cash is being used to retire debt, and the company has a really good form for doing that over FY19, 18 and 17, and will continue going into the future. If I then pass on to slide 29, which is Cardno's growth priorities, I'll just keep going for time. Our priorities, firstly, as it says on this slide, is organic growth and acquisition-based opportunities where they are straight down our investment fairway. Investors will note that the discipline that Cardno Group has displayed over the last 3 years, and we are especially pleased with, on the Cardno consulting side, the acquisition of TGM in December, and Matt's already talked to the success of the what's now Integer's acquisition of Rava Kistner. Now again, both of these are straight down our fairway, so expect to see ongoing discipline in terms of the way we make acquisitions. In terms of organic growth, it's top line in the United States, top line in Asia Pac, and top line in international development, but also bottom line in Asia Pacific by getting our EBITDA margin where it has been back to where it has been historically. And as I said earlier, we have a line of sight to exactly how we've got to do that. We're just working our way through getting ourselves to that position. So, as Ian has said, within Cardno, we are excited about the future. A lot to do, but we have a line of sight to how we want to do it. With that, I might pass over to next steps, which takes us through to slide 31. I'll just continue with the next steps. Investors will recognise these pages from both the scheme booklet and earlier slides. The main clear date is the annual general meeting and extraordinary general meeting, which will occur on the 10th of October. Investors will have received or are in the process of receiving all the various documentation associated with that. Cardno's micro website is up, the Investor Queries micro website is up, and I recommend investors, there's now 2 videos up on that page, one of which from our chairman Michael, which clearly I think articulates well the basis behind that, and I encourage investors to look at that accordingly. Finally, there is, as you would expect, a series of call lines which are available to investors for any queries, and of course the leadership teams of Cardno and Intega are available to answer investor queries as you would expect. With that, we'll pass back to you, Izzy, for quick Q&A.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel that request, please press star 2. And if you're on a speakerphone today, please pick up the handset before asking your question. We will now pause momentarily. Just another reminder, if you would like to ask a question, please press star then 1 on your telephone. We are showing no questions at this time. I'll now hand back for any closing remarks.
Okay, thank you. It's Peter Barker here. Just on behalf of the Cardno Intega teams, we thank investors for their interest today and look forward to working with you in the future. Thank you very much. Back to you, Izzy.